Welcome to today's webinar hosted by Vantage Markets Australia. My name is Ollie and I'll be your host for today. And joining me, we have the Vantage AU market analyst, Hebe Chen. So you guys might recognize Hebe from some of her appearances on Bloomberg, Reuters, AusBiz, or from the plethora of content uploaded onto the Vantage website. Hebe, we're very excited to have you here today. Thank you for coming on.
Thank you, Ollie. Thank you for having me. Yeah, thanks everyone for joining us today. I'm very excited to share my views, given that it's such an interesting and quite a jam-packed week to come.
100%. Okay, so as you guys can see on the screen, the topic for today's webinar is when markets defy expectations. So what we'll be doing is taking a look into the price action we've seen over the previous months, analyzing trends in the price action and how these may differ from traditional expectations, and giving our perspective on navigating financial markets for the weeks ahead. So, to start off, I did just want to give a quick disclaimer that anything we do discuss in this webinar is general in nature and doesn't take into account your circumstances. Any projections we give are not guaranteed, and past performance is not always a reliable indicator for future performance. So, on your guys' screen, you'll see what we believe are the major scheduled economic events for the week ahead and what we believe will be driving a fair degree of the volatility. As you can see, it is largely dominated by central bank decisions and key inflation data, but of course, we can't ignore the impact of the US and Iran war as a driver for price action. So, Hebe, in the context of what we've been seeing in financial markets recently, how would you approach the week coming up?
Well, thanks, Ollie. Yes, this is definitely a big week to come. And as you're putting up all this event here, every single event is set to impact quite profoundly for the global markets. And I think as everyone could potentially expect, the volatility, as you putting all the headings in the prior pages, is set to be the norm that all the traders have to learn how to get well with the volatilities, how to change or twist your trading strategy with it. I think this week, as we putting up the heading here, is that when the market defy your expectations, when the volatility hits the market, what can we do? So I think this week I want to focus on the three key points. The three key things I want to share with everyone is the one, how we look at the volatilities. I think everyone have a very different relationship with volatility. Let me put out the next slides. Okay. Some people like it, some people hate it, and but what actually is volatility? So I'm putting up a more of a tangible chart that you can get a feeling about it. This is called wicks. It's called the market's fear gauge, about just let you know how intense the market getting scared or getting panic about the events. And if you have been staying in the market for the past 5 years, I think all these events you probably still stay in your fresh memory. Back into COVID time, the market's volatility, the week spikes as high as 70 to 80. In the last year, the 2025, the Liberation Day, also seeing the volatility picks up quite sharply. And what this can tell us is that often when the black swan events or the big when the unexpected events happen here, the market, you do seeing the market getting quite panic, the stress level just spikes immediately, and also we'll see some of quite a sharp response from the market. And that's what the next page that I'm putting up, also the equity market's performance, just do a comparison here. So as you can tell from this, I'm putting up the square just to highlight how the market respond to all this quite extreme event happening. Back into 2020, when the COVID first hit the global market, we do seeing that the equity market fell quite sharply. And also the same cases for back into the last year, not long ago, and also the 2022 when the Ukraine and Russia war first broke out. But you can also see that market often react in the quite similar pattern, but also following that, we're also seeing quite strong recovery phase from that. Not saying that history always repeat itself, but it's just letting you know that there's always a pattern that when the market responds to the volatility, probably will give you a bit of a reference and bit of the guideline to knowing that it's not all a blank page, it's just ahead of you. The next one I want to talk about is the oil price. So I think naturally, when we're talking about what actually is volatility, the next question is, so what can I do? What can I see that respond to these volatilities and to change my trading strategies, just to knowing that what's potentially coming, So oil prices is a quite typical example because oil as a crucial energy often been viewed as the most sensitive commodity to respond to all these crises. Because, for example, let's talk about the 4 years ago when the Ukraine and Russia first broke out, what oil prices response is. It's very similar to what just happened in the past 6 weeks. Oil price spikes in the first couple of weeks because the market pricing in the fact that there's a supply disruption, that knowing that there's potentially we're getting less oil, the market will have a less supplies to meet with the demand, and that's exactly what the case is that happened in the market in the past 6 weeks. But 3 months after that, back until the June 2022, now the market shifting to the next leg of the cycle is starting from the pricing in the supply disruption to the demand disruption. Why there's a demand disruption? Because when oil price is going to high, to the very elevated level, the next thing that people were thinking about is that will that the impacting slow down the global economy and also slow down the demand for the crucial energy. And starting from that, back in June 2022, oil prices starting to taking a slide down. So again, this is not saying that history will always repeat itself, but just letting you know that there's always a sky for how high the prices could be. There's always a different playbook that potentially will play out in the months ahead. And next one, let's talk about gold and silver. I think this is one that probably the most asked and discussed, grouped um, in the past 6 weeks. Then everyone were asking why gold and silver prices perform so differently. When we everyone talking about this is safe haven, then should be the safe haven that perform the outperform during the crisis time. But this is not the case that we are seeing the gold and silver in the first 2 weeks when the war in between the US and Iran happened. And I'm putting up the chart here. You can see a bit of a comparison here. Gold and silver actually performed pretty well in the first 2 weeks when the Ukraine and Russia war broke out back in 2022. But this time it actually taking a very, very opposite path. A lot of explanations up, behind this, why this happening. For example, you could argue that because the gold and silver prices has been up so much, it's probably it's the most since 1970 for the 2025 years the performance. So given that this market is getting bit overcrowded, and then there's a lot of the reset of liquidities that's coming out from the gold and silver when the crisis first hit. But next one, I want to talk about what can we see from this pattern and what can we see from the long-term trend. So in this chart, I'm putting up again back to the what we're talking about volatility. As you can tell from this chart here, the volatilities happened to the gold market actually in the past 6 weeks. It still sits quite reasonably within its traditional range. So which means is that even though we're seeing the gold prices reset a little bit, retreat a little bit, it's not a fully collapse. It's kind of still follow what the gold prices often that will follow through when the crisis happen. There's a lot of liquidity reset into the gold market. And next one, if we taking more deeper into the technical chart here, as you can see here, I'm putting up the weekly chart. So there's multiple indicators that you can take in from this chart here. The number one is, even though we see a bit of reset for the gold and gold prices on the weekly chart, still that the weekly movement yet to breaking through this long-term and mid-term simple moving average, that which means that this 50 weeks, also the 200 weeks moving average still holds quite strongly. And the second one, I also putting up the highlight here, is that if you want to ask that what sort of which period we can compare to, based on the momentum indicator, the KD indicator, the RSI indicator, you can say that this is more mirrored what the gold prices has performed back into the April 2024. So which means that they still the pullback or the reset, the consolidation still at very measured range. Another one is, if you're taking from a near-term picture, is that you can see that after the quite initial pullback for the gold prices in the first 2 weeks of the war broke out, the gold prices actually has recovered. It has breached above this descending trend line already. So you can see that it's trying to consolidate in between the more short term, the 20 weeks simple moving average. So overall, I think my view for this market is that even we do seeing the volatility seems to defied our expectation when we expect the gold prices should be outperformed the other markets during the crisis time. Based, if you're taking a deeper or more detailed look into, I think they still in the phases of consolidation, is still in the phases of correction. It's not definitely not a fully crush for the market based on the technical view and also based on the volatility view that we're taking from the pattern. So just overall, I think what we trying to cover today is that the volatility is definitely the norm in the market. You can either like it, you can either hate it, but the thing is that volatility is often the time that we do see the market trying to reset from the previous cycle, and it's often a quite precious window that it will potentially open up on the new opportunities. It just focus on that what you have to see is which markets will benefit from the next cycle. And for all the traders, it's very good timing to taking a bit look at your portfolio and seeing that whether your portfolio will be suitable to catch up for the next cycle up.
Yeah. So just while we're on gold, I did want to ask you as well, just with regards to the traditionally safe haven argument that we would hear for gold prices. So, as you mentioned earlier as well, with gold, typically when there is economic uncertainty, we do see gold prices rise. We saw this back in, I think it was 2011, following the GFC. We saw it during COVID. Saw it last year during the first year of Trump's argument. So, do you think the recent pullback on gold prices is indicative of a fading safe haven argument?
Um, I wouldn't say it's a fading of this safe haven because often the reason actually back into the why the gold prices pull back this time, I think there's quite a lot of explanation as I discussed. I think another one is that we do have this strong competition coming from the dollar. And because the dollar kind of benefit from the storyline is that oil prices picking up, inflation picking up. So potentially we're seeing that the Fed will support the strength of the dollar. And that's actually the one of the critical reasons to behind the safe haven appeal for the gold. So that doesn't mean that the market doesn't need a safe haven for the gold. It just means the market seems to find another alternative. But now here comes the question, whether or not the strength of dollar could continue. I think they were coming back to the next 24 hours that we're getting to the Fed meeting. We're going to see the inflation data coming through in the coming weeks. So all this will challenge the way that now people seems to prefer dollar over the gold. And this playbook, I think, is very much subject to the change with the upcoming story about the inflation from the Fed meetings and all the uncertainties lays ahead. So I was saying that safe haven appeal, people still, traders still needs quite desperate for a safe haven. Whether or not that goal will coming back to catch the demand, it just have a lot of uncertainty from the dollar, from the inflation, from the economy landscape.
Yeah, so with the US inflation data, I do know right now we are seeing a period where inflation has nearly doubled what it was from August to December last year, sitting at about point 0.4 on the PCE at the moment. I know that is very much at the focus of a lot of global economies, not just the Fed solely, but I'm seeing also right now the Fed Watch tool is pricing around 100% chance of a rate hold. So does it suggest inflation isn't too much of a concern if they're not looking for hikes?
Well, inflation is definitely a top line concern, I would say that. I think that we just a couple hours ago we got the Bank of Japan statement coming out, and Bank of Japan doing the two things. One is they keeping the rates unchanged, but they lift up the inflation prediction for this fiscal years quite significantly, also lower the economy prediction. I do expect a lot of central bank will follow this process of the Bank of Japan. I think that inflation, given the oil price has been on top of 90 for 2 months and expected to stay elevated for the months to come, I think that will fit into the inflation. That will, I think people already feel that when you top up your car, when you seeing a lot of prices already seeing the spikes here. So I think that will eventually will fit into the concern that all the central bank, not just the Fed, will keeping the interest rate higher for longer.
Definitely. And also adding on to that for the Bank of Japan outlook, I know Japan is very exposed to imported energy inflation. So I know that's led to a bit of a jump up. I did see the vote from the BOJ today was coming in at 6-3. Three members actually voting in favor of a hike, but that's up from 8-1 from the previous meeting. So definitely more hawkish outlook right now from the the Bank of Japan. Obviously, I know the weakening yen is becoming very much at the forefront of conversations at the moment. So, do you think the weakening yen could have a bit more of an impact on top of the inflation data?
Well, yes, definitely. The you should say the weakening of yen is always a big topic and always a big concern for the Bank of Japan. And we know the inflation in Japan has been like above their comfort zone for it's almost 4 years now. So this is continue will be the stress point or the pain point for the Bank of Japan, given that they now having seen the economy is taking the hit from the world, taking the hit from the global slowdown of the economy. So they now seems to trap in a very awkward position. That inflation is definitely an issue they have to tackle. But on the other hand, that if the economy continue to weaken, they actually lower down the economic projection from the 1% to only 0.5%, so half of them, they were putting the economy, the Japan, in the likely a stagflation, and that means that the path ahead, the option ahead for the Bank of Japan will be even more narrowed down and it will be more tricky. So I think that will potentially putting a lot of pressure for the yen as well.
Yeah, definitely. And also, just to move it from, I guess, one economy which is very much focused on inflation to the other, I did want to ask you about the RBA, just to bring it back to the home front. So, from what we've seen on the overall trends on data for Australian CPI, we're currently entering into our seventh consecutive month for inflation outside of the 2 to 3% target band. There's also been considerable pressure from the IMF onto the RBA to get inflation under control. So I did want to ask about that one. So how do you think the data this week with the CPI will impact on the RBA forecast?
I think we're probably seeing that the all this pressure coming from the higher prices now will down into the real number, just telling us how high the inflation is in Australia. The prediction wise that we are expecting the quarterly, the Q1 inflation for the Australia will be on top of 4%. And in that case, that will be the highest level since 2023. So that's the highest level in 3 years. In terms of how they're going to translate into the real impact for everyone, including the traders, including the every household, I think very likely, I think you probably mentioned that the what going to do RBA going to do about this 4% inflation rate. So the market now, the future market is seeing a 75% chance of another hike in next week's meeting. So that would be the three straight 25 basis point if that happens. So that means that the all the households have to pay nearly 1% extra cost to the capital to your home loans. All the business have to suffer for higher capitals, the cost of capitals to grow to expand your business. So I think that we'll all putting it together will be a quite strong pressures. But in terms of how high the level the inflation could stay, I think given the oil price continues to stay such high level, as we said, that this is not just about the energy market. They will eventually translate into the all the costs or everything that the Aussie household have to pay for. So if that's the case, that very much likely we're seeing the inflation as RBA predict will stay at that level at least until the end of 2027. So which means that not only we are seeing the one more hike in May, the potentially one more hike to come by the end of 2026. I think that will be quite a sad story that we have to embrace.
Something to embrace on our side. And I've been
Yeah.
looking into today for the overall forecast from the big four banks. We've got ANZ, we've got CBA and NAB, all forecasting an additional 25% hike at the meeting following. Westpac's gone one further, predicting two to bring rates to around 4.85. But I did actually want to ask you just about a conversation I had earlier today with one of my clients. He was referencing an article I read by Adam Button on Investing Live, talking about the Australian dollar acting as somewhat of a safe haven currency amid war. And I did wonder if that was due to the energy tie links, obviously going through nat gas and all the others for commodities. Do you think that holds any weight?
Well, I would say that in any economy book, the Australian dollar is not a traditional safe haven. I think as you mentioned that because the Aussie dollar always very tightly connect or related to the commodity prices. And we know that when the crisis comes, that the global economy feel the heat is often will translate into the pressure for all the commodities, especially for all the commodities the Aussie dollars net proud of. The reason I do see why the reason supporting that is because the Aussie dollar, as that we back into the compare the all the assets performing in the first 3 weeks of the war broke out. Aussie dollar surprisingly to be the one that performed the strongest. But that's not because that is supported by the safe haven appeal. It's because supported by the way that we are suffering with high inflation, as we just discussed. We are suffering the highest inflation probably for the most the developed countries, and now we are seeing the most substantial range of the rate hike could potentially come, and that's a reason to supporting the Aussie dollar's strength. And whether or not that it will continue, again, it will back into how long the inflation will stay, how long the high inflation will keep the putting the pressures into the Aussie economy. But this is not a I won't say that this is a case that will last forever. So that means that the safe haven appeal is just a rare case that just happened to the Aussie dollar when the crisis coming, the Aussie dollars push up, but the connection there, the fundamental is not because of the safe haven appeal.
Yeah, yeah, definitely. I do think it is quite an interesting argument for the Aussies, seeing them hit some pretty significant highs, multi-year highs against the dollar at the moment. Big appeal coming over to us. And it'll be interesting to see how the hikes can actually influence that if we keep pushing above 72. I know right now we're testing resistance around that sort of level. It'll be interesting to see how the hikes push up on there, but obviously the firming dollar off the back of the oil prices will be the big story out of that one. And as well, I did want to ask just about one more for the US dollar, that is. So what I did want to ask about the US dollar is talking about global risk sentiment across markets at the moment is that we are seeing on a day by day or on maybe a smaller time frame, we're seeing the candles move quite reactionary to market driven headlines. And I want to see, are you seeing anything on the US dollar which is kind of shaping that risk sentiment or giving an indication of?
Well, yes, I think US dollar, as we say, that US dollar appears to be one of the top one benefit from this the US and Iran war, because that seems to all the safe haven capitals now flow into the US dollar in the first 2 weeks. But now coming down to the fundamental, I think the reason that we do see the US dollar has suffered quite a dip last year is because the market continued to price in the more cuts from the Fed, and also, of course, the pressure coming from the president. Now, the US dollar is coming at a crossroad because, on the one hand, as you just saying, that the inflation in the US inflation coming from the oil price will continue to fit into the market feel that it be cautious about should we still to price in a Fed cut by the end of this year. I think this question will continue to impact the US dollars. But on the other hand, don't forget the cases that is the Fed is now at the transition of a different leadership. So when that the power finish his term likely in the upcoming meetings that we do see the Kevin Walsh will step in. I think they will have a vacuum phase is that market will have a bit more uncertainty about what the policy will be like under the new leadership. And these are two elements. On the one hand, is the economy element. On the other hand, is the leadership or the policy elements. These two will be working together to underpin that the US dollar. So I think for the weeks or for the months ahead, it's now predicted is that the Fed is unlikely to cut as the market predict it will be, but also it's quite unlikely to raise interest rate like RBA. So that will likely putting the US dollar at a more steady phase, given there's so many uncertainties, so much uncertainties just ready to be unfold.
Very much. I did see, supporting that one, I did see an article on Reuters as well, talking about one third of the economists they polled are expecting no rate cuts through till the end of the year. So, off the back of that, we did see some firming on the dollar, but it's hard to say really if it's a result of the war, if it's a result of, Fed forecasts and everything like that. But I guess that's where it all comes into. There's a lot of volatility. There's so many factors which are driving prices one way or the other, and it's definitely an interesting market to be a part of for it. But I think that probably brings us off to, I guess, the end of the webinar, end of the discussion, which we do have. for today. So moving into the questions, main one I did have was just talking about the RBA and the forecast. But I guess if we are speaking on the RBA topic as well, how we look at the equity markets potentially off the back of some of the data we're seeing.
Yep. So Australian market has been down. I think today is the 6 days, 6 straight days. So which I think just highlights how the market feel unsure about what is coming. And then we know that in the next 48 hours, we have the AU, Australia's inflation. We do have the market will quickly pricing in what the RBA will do next week. We also have the May 7th earnings coming out, also the Fed. I think that it's quite prudent, it's quite understandable that market taking a bit cautious stance just ahead of so many uncertainties. And given that in terms of long-term outlook, I was saying that um, again, I think that given that so much volatility is happening, but often the volatility is always followed with a recovery phase. It's just that when the recovery phase will coming for the Aussie market, I think potentially is if the peace talk can get more meaningful development, the market feel that more peace of mind that they won't have too much hit to the global economy, to the Aussie economy. I think that probably the shifting points that coming up. And also the next thing we're probably thinking about is that the in terms of the fundamental of the Australian stocks or fundamental of the Australian markets, whether we can get a strong data to supporting the view that the hit from the oil crisis, the hit from the inflation will have just limited a minimum impact into the fundamental earnings and profitability for the Aussie companies.
Yeah, also interested to see if gold goes on another strong bullish run, if how the impact on the Aussie
Yeah.
stock market. But okay, moving on from that one. So that brings us to the end of the webinar today. So I want to say a massive thank you to Hebe for coming on. Shares a very insightful information in there as well. So I want to thank you for that. Thank you everybody as well for watching. For all those who have registered for the webinar, we will see a recording of this one uploaded onto YouTube once we have concluded. As well, we will be posting some more information about this in the VIP chat room as well as on Telegram. For anybody who is looking to see some more of Hebe's content, please feel free to go onto the Vantage website or follow us on any of our socials for any up-to-date updates. All right. Yeah, so thank you everybody for watching, and Hebe, thank you very much as well.
Thank you, Ollie. Thank you everyone for joining us today.